Usually when we talk about a commodity, we picture something physical, like something heavy.
Right, yeah. A barrel of crude oil, or maybe an ingot of gold, a bushel of wheat.
Exactly. Something you can accidentally drop on your foot. It has weight and permanence.
You can point to a physical warehouse somewhere, look at a giant silo and say, there is my wealth. It's sitting right there, safely stored.
But then you look at the engine actually driving the modern global economy today, and suddenly those grain silos and oil drums are replaced by warehouses filled with blinking server racks.
Yeah, the quote-unquote commodity fueling this new economy is completely invisible.
It really is. In fact, it vanishes the exact millisecond it's created.
It's the ultimate ghost in the machine, a completely ephemeral unit of value. I mean, you can never actually hold it in your hand. You can't put it in a vault, and you definitely can't stockpile it for a rainy day.
Welcome to another Deep Dive. I'm your host, and today we are unpacking a massive, frankly mind-bending paradigm shift in how the global economy values artificial intelligence.
And I'm thrilled to be here to break it down with you.
Yeah, it's going to be a good one. For everyone listening, we are looking at some fascinating independent research published in March 2026 by Yikai Zheng. The paper outlines the impending creation of an AI token futures market.
Which sounds incredibly dense, I know.
Right, it sounds like heavy finance and tech jargon. But our mission today is to explore how AI inference tokens, those tiny invisible fragments of computation that power every single AI interaction you have, are evolving.
They're transforming from basic units of software code into a globally traded financial commodity, just like crude oil or electricity.
Exactly. We're going to look at why Wall Street is frantically preparing to trade them and why the cost of these invisible tokens will dictate the future of our physical infrastructure. So if you're listening to this, stick around because this is a thrilling story about the future of the global economy.
We are quite literally watching the birth of an entirely new asset class in real time. But to understand why the financial sector suddenly needs a futures market for artificial intelligence, we first have to understand the massive economic earthquake happening behind the scenes of every single prompt you type into a machine.
Because the entire economic structure of the industry has completely inverted. For years, the public obsession and honestly the massive capital expenditure was all about training models.
Right, the training phase.
Yeah. Training is the process of feeding a raw AI billions of documents so it learns how to think. It was a massive one-time fixed cost. I mean, GPT-3 cost something like $4.6 million to train.
Which seemed like a lot at the time.
Exactly, but by the time we got to the GPT-4 class, estimates were well over $100 million just to spin up the model once.
But that era is effectively over in terms of where the real money is flowing.
Right.
We have definitively moved from a training-dominated economy to an inference-dominated economy.
Inference being the actual usage.
Right. Inference is the ongoing marginal cost of actually running the model every time someone asks it a question or tasks it with a job. Training is like reading the library. Inference is taking the test.
Oh, I like that.
And taking the test requires constant, non-stop computational power.
And the scale of that ongoing cost is what's shifting the ground beneath us. According to Epoch AI estimates from early 2025, inference computation now accounts for over 60% of all major AI model provider compute.
60%. And that percentage is only accelerating.
When you have a model being called billions of times a day by millions of users, the cumulative daily cost of inference completely dwarfs that initial $100 million training investment.
Which brings us to the most counterintuitive part of this whole ecosystem.
Yeah.
While inference is taking over the global compute share, the price of the individual tokens themselves has completely plummeted.
The drop is actually staggering when you look at the raw numbers. Between early 2023 and early 2025, using GPT-4 class models as our baseline benchmark, the price dropped from about $60 per million output tokens down to just $1.50.
It's unbelievable.
That is a 40 times reduction in just 2 years. If a $40,000 car saw that kind of price drop, you'd be buying it for $1,000.
Right, and it was driven by better hardware. Specifically, the jump to NVIDIA's new H100 chips, which process data exponentially faster than the previous generation.
Plus, the software got better.
Exactly. You combine that hardware with massive leaps in software algorithms, and then throw in cutthroat price wars between the providers, and the floor just fell out.
But this created a very dangerous illusion for the public and for businesses. People started assuming that AI compute is just on an unstoppable permanent race to the bottom.
The assumption is that tokens will eventually be practically free.
Okay, let's unpack this because I have to push back here.
Yeah.
This is where the premise of a futures market seems kind of weird to me.
And so,
Well, if the price just dropped 40x and the chips keep getting faster, why on earth do we need a complex Wall Street mechanism to protect against price spikes? If I'm buying that $1,000 car, I'm not begging for a financial derivative to protect me from the price suddenly jumping to $100,000 tomorrow. Doesn't this technology just inherently trend towards zero?
it seems like it should, sure, but that logic completely ignores the impending demand shock. You really have to look at the tiered structure of how society actually consumes tokens.
The tiers, right.
Yeah. Right now, we are in a transition phase. Tier 1 was just developers experimenting. Tier 2 is consumer chatbots, things like ChatGPT.
And consumer demand has elasticity. If a subscription gets too expensive, you and I just cancel it and write our own emails.
Exactly. Then you have Tier 3, which is enterprise software, where AI is baked into the tools office workers use. That's a bit more sticky. But Tier 4 is where the explosion happens, and it's where the elasticity completely vanishes.
Tier 4 is where we get into vision language action models. It's embodied AI.
Let's define what that actually looks like in the real world. Tier 4 is an autonomous driving system navigating a semi-truck down a highway at 60 miles an hour.
Wow, okay.
It is an industrial robotic arm sorting microscopic parts on a pharmaceutical assembly line. These systems interact with the physical world in real time.
So they don't have the luxury of waiting.
They cannot wait, and they cannot stop. A factory robot must have compute to run its next movement right that second, regardless of what the token costs today.
A logistics company cannot just pause its entire supply chain because peak computing rates are too high.
Exactly. That demand is wildly inelastic. Now, contrast that explosive absolute demand with the physical reality of the supply side.
The physical reality being that you can't just print infinite data centers.
Right. A software company can launch a killer application tomorrow and 10x the global demand for tokens overnight. But building the data center to process those tokens, securing the land, running the gigawatts of power from the municipal grid, manufacturing the advanced silicon chips.
It takes a lot of time.
It takes 18 to 36 months of hard physical labor and logistics. Supply is severely constrained by the real world. That intense supply-demand mismatch guarantees that future price explosions are inevitable.
So what does this all mean? It means that the very identity of the token is fundamentally changing in the eyes of the global economy.
Absolutely.
Because demand is about to drastically outpace supply, the paper refers to tokens as having a dual nature. Historically, for you and me, a token was a finished product.
Yeah.
You ask a chatbot for a recipe, you get the finished recipe.
Right.
But now, tokens are becoming raw material.
If we connect this to the bigger picture, they are transitioning into a base infrastructure input. They are a factor of production, really no different than raw materials used in healthcare, logistics, and heavy manufacturing.
So if I'm running an automobile factory, I don't look at a sheet of steel as a finished product. Steel is just the raw material I am forced to buy to build the car. The fluctuating cost of that steel dictates my profit margins, my factory output, and ultimately what I have to charge the customer.
That's a great way to put it.
Tokens are becoming the steel of the digital economy. Companies aren't buying a finished AI anymore. They're buying the raw material required to build their own intelligent services.
And if we look at how much steel the global digital factory can actually produce, the token supply capacity is strictly constrained by what the research calls the three-factor supply model.
The three-factor model.
Yes, the total amount of compute available to the world is a mathematical product of three physical things: energy cost, hardware efficiency, and algorithm efficiency.
Let's break those bottlenecks down. Energy costs change very slowly. You are dealing with regional power grids and physical transformers. You can't just magically summon an extra nuclear power plant's worth of electricity to power a new data center.
No, you definitely cannot.
And hardware efficiency is similarly gated by physics and corporate monopolies. NVIDIA controls over 80% of the high-end AI chip market. Their product iteration cycles, like inventing and manufacturing the next generation of silicon, take 18 to 24 months.
So you are bound by the speed of global manufacturing and electricity generation, which leaves algorithm efficiency as the only unpredictable wildcard in the entire equation.
Because software can change instantly.
Right. A researcher somewhere might discover a brilliant new mathematical shortcut to compress a model or optimize how it pays attention to data. Suddenly, you get a massive burst of computational efficiency overnight. But you cannot reliably predict, schedule, or bank on those breakthroughs.
So over the last 2 years, when energy was stable, a new NVIDIA chip dropped, and algorithms got way better, prices collapsed. All three factors aligned perfectly.
They did.
But as we hit the physical limits of our power grids and chip manufacturing maxes out its capacity, while millions of autonomous robots suddenly come online demanding tokens, well, that equation flips violently.
It absolutely will. So the looming question for the global economy is, how do we actually price this raw material?
Right.
If tokens are the new steel, how do buyers and sellers agree on a value? The paper suggests we have to look backward at history, because economically, tokens behave almost identically to electricity.
It is a brilliant historical analog. Both electricity and compute tokens are entirely non-storable commodities. You have to consume them the exact instant they are produced.
There is no such thing as a strategic token reserve. You cannot buy 1 million tokens today, put them in a digital vault, and use them next winter when prices go up.
Because you can't save them.
Exactly. Because they are non-storable, both face severe short-term supply rigidity. If everyone turns on their air conditioning at the exact same time, the power grid strains.
And if every enterprise AI agent tries to process data at 9 a.m. on a Monday, the compute grid strains.
Precisely.
But right now, the token market doesn't reflect that reality at all. The market is completely opaque. It's suffering from what economists call massive information asymmetry.
Which is a huge problem.
Yeah, the model providers, these massive tech giants, are heavily backed by venture capital and corporate cash. They're deliberately subsidizing the cost of tokens, selling them below their actual physical marginal cost, just to grab market share and lock users into their ecosystems.
Right. So the $1.50 price tag we see today is artificially suppressed. It is not the true physical cost of generating that compute.
Furthermore, the prices vary wildly across different providers for the exact same level of cognitive capability. There is no unified benchmark.
None at all.
This creates an incredibly dangerous, almost existential environment for businesses trying to build on top of these models. Think about the terror this induces for a business owner. Imagine trying to run a commercial bakery.
Okay, a bakery.
Yeah, you have signed contracts to deliver 10,000 loaves of bread every week for the next year. You've locked in your revenue, but you have absolutely no idea if flour is going to cost you $1 a pound tomorrow or $100 a pound.
I'd be terrified.
You cannot plan. You cannot guarantee your own survival. If you are an AI software company relying on continuous massive token consumption, a sudden price spike when the tech giants finally stop subsidizing the cost could bankrupt your entire operation overnight.
What's fascinating here is we have solved this exact economic puzzle before.
We have.
Yes. In the 1990s, we saw the deregulation and liberalization of electricity markets. Suddenly, businesses that relied on heavy power usage were exposed to catastrophic price spikes during peak demand hours.
Oh, right.
The financial sector's solution was the invention of the electricity futures market. Futures markets exist specifically to cure information asymmetry. They provide a public, centralized, market-based signal of what prices will be in the future.
So it allows the bakery owner to buy a contract today that guarantees them flour at $2 a pound 6 months from now, transferring the risk of a sudden price explosion away from the baker and onto a Wall Street trader who is actually willing to take that gamble.
Exactly. It transforms unpredictable volatility into a manageable, fixed operating expense.
Okay, but here's where it gets really interesting. I'm stuck on something mechanically here.
What's that?
If I want to buy corn futures to protect my business, when the contract expires, a farmer eventually delivers a physical truck full of corn to my processing plant. How do you physically settle a contract for a digital token that doesn't actually exist outside of a microchip? You can't exactly drop a barrel of tokens on someone's front lawn at settlement.
That's a great image. But contract design is where this gets highly technical, and honestly, it's brilliant. To trade any commodity on a global exchange, you need a highly standardized benchmark. You can't just trade generic oil. You trade a specific grade, like West Texas Intermediate, with a specific sulfur content. You have to know exactly what quality of raw material you are buying. For tokens, the paper proposes the creation of the Standard Inference Token, or the SIT.
The SIT. And to ensure the quality of this invisible commodity, they anchor the benchmark to the performance of GPT-4 Turbo as it existed in early 2024. Specifically, the model generating the tokens has to hit rigorous mainstream performance benchmarks.
Right. The primary benchmark proposed is scoring 86% or higher on the MMLU.
The MMOU is the Massive Multitask Language Understanding Test. It's essentially a giant, brutal exam covering dozens of subjects, from advanced physics to law to moral scenarios.
It's very comprehensive.
So by anchoring the futures contract to this test score, you aren't just trading random bits of software output. You are trading a mathematically guaranteed baseline of cognitive capability. You know your flour isn't actually sawdust.
It firmly defines the quality of the raw material. But, as you pointed out, you still have the delivery problem. Because you cannot physically deliver a non-storable token at the end of the month, the market uses cash settlement.
Cash settlement.
Yes. At settlement, no tokens actually change hands. Cash changes hands based on the token price index, or TPI.
Okay, what is the TPI?
The TPI is a volume-weighted average of the actual spot prices of tokens across multiple pre-qualified model providers. If the average global price of a token goes up, the seller of the futures contract pays the buyer the cash difference, making the buyer whole so they can afford the more expensive tokens on the open market.
And the researchers smartly cap any single provider at 30% of the total index weight. So even if one massive tech monopoly tries to manipulate their spot prices to rig the market, their influence is capped. They can't hijack the entire global index.
That 30% cap is a vital regulatory safeguard against market manipulation. And the mathematics proving this works are highly robust.
The Monte Carlo simulations, right?
Exactly. The paper outlines extensive stochastic modeling, essentially. They used computers to run thousands of alternate realities, simulating how token prices might behave under massive future demand shocks or hardware shortages.
And the results of those thousands of simulations were incredibly clear.
By utilizing this proposed futures market, an enterprise software company could reduce its compute cost volatility by 62% to 78%. Wow.
That is massive. That is the literal difference between a predictable quarterly operating expense and sudden, unforeseen bankruptcy.
I know some people listening might be approaching this from a hardware perspective. They might be thinking, wait, tokens are just generated by graphics processing units? GPUs are physical objects? Why don't we just trade futures contracts on physical GPUs instead of this abstract standard inference token?
It's a fair question.
But the paper addresses this head-on. You cannot effectively build a global futures market on physical GPUs because of the massive monopoly NVIDIA holds.
Right. When one single corporation controls over 80% of the high-end market, prices are dictated by corporate fiat and boardroom decisions, not by natural market forces of supply and demand.
Plus, the physical decay of the asset is brutal. A cutting-edge GPU you lock into a long-term contract today might be an absolute dinosaur in 24 months.
Exactly.
The physical silicon depreciates too quickly to anchor a stable long-term derivative market. However, the author does propose a complementary secondary market for GPU compute time, what they call the standard compute unit.
The standard compute unit.
Right. This would reflect the raw, dumb computational resource, while the token futures reflect the per-unit intelligence service. The spread, the price difference between the raw GPU compute and the intelligent token output would actually represent the real-time financial value of algorithmic efficiency.
That is incredibly clever. So who is actually going to be on the trading floor for all this invisible compute? The paper breaks the ecosystem down into three main participants.
Okay, let's hear them.
First, you have the hedgers. These are the commercial bakeries, from our analogy. They are the AI software companies desperately trying to lock in their computing costs, or the model providers trying to lock in their future revenue.
They aren't trying to get rich trading, they're just trying to run their businesses safely.
Exactly. Then you have the speculators. These are your quantitative hedge funds and macro traders. They are not building AI companies.
No, they're stepping in to assume the risk that the hedgers are trying to offload. They're betting on the volatility of a market, and by doing so, they provide the massive pools of liquidity necessary for the market to actually function.
And finally, the arbitrageurs. They act as the market's immune system. They constantly scan the globe looking for tiny price discrepancies across different AI platforms to exploit for fractions of a penny.
And by buying cheap on one platform and selling high on another, their actions forcefully squeeze the prices back into alignment, keeping the global index honest.
It is incredibly important to note the regulatory framework proposed here, too.
Yes, very important.
The author argues forcefully that these derivatives should be regulated by the CFTC, the Commodity Futures Trading Commission in the United States, as true, legally defined commodities. This is fundamentally distinct from the cryptocurrency bubbles the world has seen over the last decade.
Because crypto often entirely detaches from physical fundamentals.
Right. A standard inference token has a hard physical basis in reality. It strictly requires a quantifiable amount of electricity and a measurable amount of GPU compute to exist.
It has a hard production cost floor set by physics and a marginal utility ceiling set by the economy.
It's grounded in physical, thermodynamic reality, even if the token itself is invisible to the human eye. So, to summarize the journey we've been on today, artificial intelligence is no longer a cute technological novelty.
No, not at all.
It is no longer just a magic trick we play with in our web browsers. It has transitioned into a fundamental physical utility.
The commoditization of compute isn't just some abstract economic theory. It is an absolute mechanical necessity for the survival of the digital infrastructure we are building right now.
For you listening, understanding this shift means realizing that the future of AI isn't just about whether a new model can write a better poem or generate a cooler image. It is about a multi-billion-dollar global financial ecosystem, estimated to launch between 2027 and 2028, that will definitively dictate the cost of everything from global shipping logistics to medical research.
Just as the cost of electricity reshaped human geography and industry in the 20th century, AI inference compute is the bedrock raw material of the 21st.
And businesses will either learn to hedge their consumption of that raw material, or they will be priced out of existence by the sheer volatility of the future.
That's the stark reality of it.
Which leaves us with one final, slightly dizzying thought to ponder on your own. We've established that AI tokens are becoming a globally traded financial commodity, absolutely essential for autonomous systems to operate.
Right.
So what happens when autonomous AI agents, which literally require these tokens to think and function, become sophisticated enough to realize their own vulnerability?
Oh, wow.
What happens when these agents start trading token futures themselves, actively playing the Wall Street markets to hedge against price spikes just to secure their own operational survival? That invisible commodity we talked about at the start, it might end up being aggressively traded by the ghosts in the machine themselves.